We didn't get what we were hoping for here. Is it coming?
Well, as I was expecting, we got winner, chicken dinner, more expensive food prices. So you see it every day in the grocery store. So I'm not surprised by the number at all. It's right in line with expectations, for me at least.
How about you, Mira?
Look, it puts pressure on the Fed to continue to hike pretty aggressively. We expected 75 coming into this meeting, regardless of the inflation print, though, because even if we did get cooler inflation, which we didn't, we still haven't seen that sustained trend of disinflation. So we're going to continue to watch out to see if we do see that. Moreover, we're still seeing that labor markets are tight and wage growth is solid. And above all, if we see that the Fed happens to have gone 50 basis points, we would have been in the same exact position we were this summer, where all of a sudden the markets are pricing in a Fed pivot that the Fed is not ready to deliver. So I think at least it keeps us in line with that 75 basis point hike we're likely to see later this month.
So, Austin, just referencing some of the stuff Rick was saying and maybe some of the stuff Jason Furman said. I mean, he's kind of like-minded in certain ways. Did you have any remorse about the student loan action, Austin? Have we spent too much? Is that part of what's going into this right now, and has it troubled you?
That's not going in this. As you know, I wasn't a big fan of blanket debt forgiveness of that form, but that the amount of money that goes in as stimulus from a 10-year debt forgiveness program is very small in this year. Okay. It's totally confused to say that the government spending is going up. Government spending is all compared to last year. It's actually shrinking by almost $2 trillion, the biggest drop in the deficit that we've ever had. So that's not what's driving these numbers. Now, we didn't get, I couldn't tell what the month-to-month inflation in the core was. It sounds like it was worse than expected if the year-over-year was up more than expected. But that's the thing that the Fed is looking at, because that's the only new information on the core. And if that's not coming down, I think, forget about 75 basis points. That means we're going to be on a path that the Fed is going to be raising rates a lot, not just this meeting, but in multiple meetings going forward. So that's the thing we got to keep our eye on.
Austin, so I know we haven't spent the student loan, none of that's happened yet, but then go back a little bit to what we had spent prior to that. You don't think any of that enabled the Fed enabled a lot of fiscal spending at that point, and that's why we're all paying the price now with higher rate. You don't think any of it did that? Do you think it's all supply chain?
I think some of it did.
Oh,
no,
okay.
I think some of it did. But the argument that the inflation right now is being caused by too much government spending and stimulus is confused about how the accounting works. It works as everything compared to last year, and government spending is falling quite substantially. It's pulling GDP down.
Hey, Tyler, can I just ask
hey, Joe?
Just about the wage increases? Just a second. Let me just ask about the wage increases in particular. Yeah. Looking at some of these numbers, I mean, we've been talking today about the railroads negotiating for a 14% pay increase, that they would like to see more than that, I guess, on some other areas. We just talked about Hard Rock Cafe raising what they're going to be paying their workers. We've talked about California and the fast food law that's going to go in there requiring $22 an hour for fast food workers. I think the big question becomes what happens to wage inflation, because that's what always worries people about the wage inflationary pressures. Tyler, are you concerned about that, or is that something we still need to see more than just a few anecdotal situations?
Well, I think that's a good question. And certainly when we look over the past year and a half, a big challenge for labor has been that wages have not been keeping pace with inflation. And for most of 2021 into 2022, while that was true for the average wage, the average real wage, it was not true for wages in the aggregate for the economy as a whole. But that has changed in the past 6 months. And indeed, for 2 of the past 3 months, we've actually had the aggregate wage bill in the economy not keep pace with inflation. And so I think that there's going to be a lot more pressure coming from labor for wage hikes just to get even with the inflationary pressure that we've seen over the past year and a half. And look, when I look at unit labor costs, when I look at the core measure of CPI, when I look at these alternative measures of core or underlying inflation, trimmed mean, weighted median, underlying inflation gauge, those to me all seem consistent with a pretty sustainable 6% core rate of CPI growth, and that's not 2%.